Your mortgage rate is about 6.5%. Your bank didn't pick that number. Neither did the Federal Reserve. It came from one bond, trading in a market you have never once opened. And over 30 years, a small move in that bond is worth about $48,000 to you. So, 3 things in the next 10 minutes. The one rule that runs this entire market. That 48,000, shown in dollars instead of percentages. And the part almost every video on this subject gets wrong. The global bond market holds more than $156 trillion in outstanding debt securities. That figure is from the Bank for International Settlements. For scale, the entire global stock market is smaller than that. But a number that size is useless to you, so let's narrow it. Roughly $58 trillion of it sits in the United States. Still too big. Narrow again. Inside that American pile, there is one bond that matters more than all the others combined for your personal finances. It is the 10-year US Treasury. That's the one. By the end of this video, you'll be able to look it up in 5 seconds and know exactly what it's telling you about your own money. A bond is a loan, pointed in the direction most people don't expect. You are the lender. Someone needs money, a government, a company, a city. Instead of walking into a bank, they borrow it from investors. You hand over a fixed amount, called the principal. In return, they promise 2 things: a fixed payment every year, called the coupon, and your principal back on a specific date, called the maturity. That is the entire instrument. Bonds are not complicated. What makes them powerful is that almost everything else in finance gets priced against them. There is exactly one rule you need. Everything else in this video is that rule operating at a larger scale. When interest rates rise, the price of existing bonds falls. When rates fall, existing bond prices rise, opposite directions, every time. Here's why, with real numbers. You buy a 10-year bond for $1,000, paying 3%. It pays you $30 a year. A few months later, new bonds are being issued at 5%. Those pay $50 a year for the same $1,000. Now you want to sell yours. Nobody is paying full price for $30 a year when they can buy $50. So your price has to fall until the return evens out. For a 10-year bond, that price lands around $846. Notice what did not happen. You did not lose a single payment you were promised. It still pays $30 a year, and it still returns your full $1,000 at maturity. But today, on paper, your $1,000 is worth $846. Hold on to that rule. We're going to use it twice more. When a bank decides what mortgage rate to offer you, it does not invent the number. It looks at the 10-year Treasury and asks itself one question. Why would I lend money to a household for 30 years when I could lend it to the US government for 10 years, risk-free, at whatever the 10-year is paying? The answer is that it wouldn't. Not unless you pay more. So the bank takes the 10-year yield and adds roughly 2 percentage points on top. That spread is the price of you being a person, instead of a government, the risk that you lose your job, get sick, or stop paying. 10-year at 4.5, add about 2, and you land near the national average 30-year fixed rate of roughly 6.5%. That is the entire chain. Treasury yield plus a spread equals your mortgage. Nothing else in between. Percentages don't land. So let's use a person. Dana is buying a house. She needs $400,000, 30-year fixed. At 6.52%, her monthly principal and interest comes to $2,534. Now suppose the 10-year Treasury rises by half a percentage point over the next few months. Not a crisis, an ordinary move. Her mortgage rate follows it up to about 7.02. Her payment becomes $2,667. That is $133 more every month for 360 months. Over the life of the loan, roughly $48,000 for half a point. Now widen the lens. In January 2021, the 30-year fixed hit an all-time low of 2.65%. At that rate, Dana's payment would have been $1,612. In October 2023, the same rate peaked at 7.79. That identical $400,000 loan costs $2,877 a month. Same house, same buyer, same loan amount. The difference is $1,265 every month, about $455,000 over 30 years. And here is the part that should bother you. Nobody sent Dana a letter about this. There was no announcement, no vote, no meeting she could have attended. The bond market moved, and she signed whatever it decided, which raises an obvious question, and it's the one I'd be asking right now if I were watching this. If a bond can quietly add $400,000 to the cost of a house, what does it do to the mortgage you already have? Now I want to slow down, because this is the part almost every video on this subject skips, and it happens to be the part that actually applies to most of you watching. If you already have a 30-year fixed mortgage, none of this changes your payment. Not by $1. Not ever. That is what fixed means. You locked a rate, and the bond market can do whatever it likes for the next 3 decades. Your payment is frozen. When the 10-year jumps, your neighbor buying today feels it. You do not. So who does this actually reach? 3 groups: people buying a home, people refinancing, and people holding an adjustable rate mortgage where the rate resets on a schedule and the bond market gets a vote every single time. If you are buying or refinancing, the 10-year Treasury is the most valuable number in your financial life right now because it sets the rate you will carry for the next 30 years. If you have an adjustable rate mortgage, this is not trivia. It's your budget, and if you are in none of those 3 groups, you already won. You bought certainty, and you're finished. I think that's worth saying out loud. Because a 30-year fixed mortgage is one of the very few genuinely calm decisions available in personal finance, and most people who made it have no idea how good it was. So what actually pushes this number around? 3 things. You do not need more than 3. First, inflation expectations. If lenders believe a dollar will buy less in 10 years, they demand more yield to compensate for it. Higher expected inflation, higher yields. Second, expectations about the Federal Reserve. Notice the word expectations. The Fed sets short-term rates. The 10-year is the market's collective guess about where rates are heading over an entire decade. That's why mortgage rates sometimes fall before the Fed has cut anything at all. The market moved first, on the guess. Third, the term premium. Lending money for 10 years is riskier than lending it for 3 months, for the simple reason that more can go wrong in 10 years than in 3. Investors want to be paid for the wait. Inflation, the Fed, and time. Everything else you hear on the news is commentary on those 3. 3 things you can do with this. None of them require you to become an investor. 1. Look up the 10-year Treasury yield. It takes 5 seconds. When it climbs, mortgages and car loans climb behind it. When it falls sharply, the bond market is usually bracing for a slowdown. It is the closest thing your financial life has to a check engine light. 2. If you own a home, decide your refinance number now. Take your current rate, subtract 3/4 of a point, and write it down somewhere you will actually see it. Not because you're going to act tomorrow. Because when the moment arrives, you will already know that it's the moment. People miss refinance windows through inattention, almost never through bad math. 3. Check what your cash is earning. The national average savings account pays a fraction of 1%. Short-term Treasury bills and high-yield savings accounts have been paying several times that. At comparable safety, T-bills are backed by the Treasury, and high-yield accounts are FDIC insured up to the limit. On $50,000 of cash, that gap runs well over $1,000 a year. Same money, same risk, different institution. And notice where that gap comes from. The yield on a Treasury bill is set by the market we've been talking about this whole time. Your savings rate is set by your bank. When the bond market repriced, one of those 2 moved immediately, and the other one took its time. The bond market is not something rich people do. It's the plumbing underneath the price of your house, the yield on your savings, and the value of the safe half of your retirement account. The people who understand it are not smarter than you. They just stopped assuming it was boring. 1 number, 5 seconds. That's the entire assignment. And here's my question, and I actually want the answer down in the comments. Did you already know that a fixed mortgage payment cannot move, no matter what the bond market does? Or is this the first time somebody said it plainly? I have a feeling the split on that is going to surprise both of us. I'll see you in the next one.